Most traders measure themselves by wins and losses. They feel good when they're winning and crushed when they're losing. But that's not how professionals think. The real measure of a trader isn't whether you win or lose on a given day. It's expectancy. Expectancy is the formula that reveals whether your edge actually produces profits over time, regardless of the randomness of individual trades. And if you don't understand this, you'll always be at the mercy of short-term results. Welcome back to Trader's Audio Edge. Today we're going to break down why expectancy is the true north of trading performance. Expectancy is a simple concept. It's the average dollar amount you can expect to make or lose per trade over a large enough sample size. It accounts for your win rate, your average win size, and your average loss size. When those numbers combine to produce a positive expectancy, you have a system that can make money consistently over time. When they don't, no amount of effort, emotion, or willpower can change the outcome. This is where so many traders get stuck. They obsess over being right. They chase the perfect setup. They look for ways to avoid losses altogether. But expectancy reminds us that losses are built into the game. In fact, you can lose more trades than you win and still be profitable if your expectancy is positive. A trader with a 40% win rate but who makes $3 for every dollar lost will outperform a trader with an 80% win rate who makes $1 for every dollar risked. It's not about how often you win. It's about how much you win when you're right, compared to how much you lose when you're wrong. Here's what makes expectancy so powerful. It strips the emotion out of trading results. 1 trade doesn't matter. 10 trades don't matter. Even a streak of losses doesn't matter if you know your system has positive expectancy. What matters is sticking to the process long enough for that expectancy to show up in your results. Just like casinos don't care about whether one player wins big at a table, traders with expectancy don't care about single outcomes. They know the long run favors them because the math is on their side. When you shift your focus from individual wins to expectancy, everything changes. You stop taking losses personally. You stop getting overconfident after a win. You stop sabotaging yourself by abandoning your edge too early. Instead, you anchor your identity in being the kind of trader who executes consistently, manages risk, and trusts the math. That shift builds emotional resilience. It gives you the calm to sit through losing streaks without fear, and the discipline to keep pressing your winners without greed. And here's the key. Expectancy is only real if you execute it. If you deviate from your plan, if you move your stop, if you let emotions override your rules, your expectancy disappears. Your job isn't to control the outcome of any single trade. Your job is to stick to the process that gives you positive expectancy, trade after trade, week after week, month after month. So here's today's takeaway. Stop asking, did I win or lose? Start asking, am I trading with positive expectancy? If the answer is yes, then the only thing left to do is to execute with discipline and let the math take care of the rest.